Hello and welcome to the Female Property Expert podcast, where I, Emma Morby, break down everything you need to know about property investing in a way that's kind of simple, easy, and actionable. Now, in today's episode, it's all about profit. Specifically, how do you calculate whether your property investment is actually making you any money? So we'll break down the terms like ROI, if you've heard that, yield, cash flow, and other essential figures, basically, that every property investor should understand before they start investing. Whether you're just starting out or you're growing your portfolio, I suppose this episode is designed to help you analyze your investments more and be a bit more confident. So let's get started. So what is meant by ROI? To be honest, why does it matter? Now, ROI, which you may have heard, stands for return on investment. And it's one of the simplest ways to measure whether or not your property investment is actually performing well. Now, think of ROI as a percentage return that you're going to be getting back for every pound that you've actually invested. So every bit of hard-earned money that you've invested, you're looking at it as a percentage. Now, there is a formula for the ROI, and the calculated formula is pretty simple. As an example, profit from investment divided by total investment cost times 100. That's the simple formula. But if I've got to break it down further for you, profit from investment, this is the income that you generate, i.e. rental income, minus expenses. So that's take away your mortgage payments, any repairs, any property management fees, any service charge fees, anything like that you deduct, and you're left with your rental income. And then the total investment cost, that is the full amount that you've spent, including any deposits, renovation costs, legal fees, any upfront costs or expenses you've had to pay out. It's basically all of the money that you physically had to pay out to purchase that property. So if I give you an example, because I think I work well with examples, so I'd like to do this. So let's say you've invested £20,000 of your own hard-earned cash in a property with a total purchase price of £100,000, let's say. And after all expenses, the property generates £5,000 in profit annually. So every year it generates £5,000 in profit. Now your ROI would be £5,000 divided by £20,000, because that's your initial investment, times 100. So this is going to give you 25%, which is a great ROI. And that means that you're going to be getting 25% return on your initial investment that you've been making. And then it may go up or down each year. But it's important to look at your property portfolio, if you have one already, and work out whether it is actually performing and you're getting a good return on your investment. Now, a good ROI can vary depending on your location. It also depending on your strategy, your risk tolerance. There's a lot of things that come into play. But typically anything kind of between 8 or 10% is considered pretty solid. But in some areas, you might only get 5 to 7%, for instance, and that would still be classed as a good return if property prices are expected to rise or if rental demand is really stable in that area. So it really does depend on what your strategy is as to what your return on investment would be and how, that percentage would be. But I typically say around about 10% is quite a good place to aim for. Now, remember that ROI can change over time based on market conditions. Changes in rent or the condition of the property itself can change that as well. So it's crucial to calculate the ROI periodically to ensure that your investment is still performing as expected. Because what you don't want to do is buy it and then leave it for a few years. And then when you go back to it, you realize it's actually losing you money. It's not making you money, or it's below the investment threshold you'd be willing to do. This is something you constantly go back to. Next, I want to talk to you about understanding yield and how to calculate yield. So, big question, what is yield? Yield is another important term that you'll hear in property investing. It's often confused with ROI, but they measure slightly different things. So yield is essentially the income that you generate from your property as a percentage of your property's value. So I'll read that again. Yield is essentially the income you generate from your property as a percentage of your property's value. Now, there is a calculation for this, as you would imagine, and it is your annual rental income divided by your property value times 100. So let's say that you purchase a property for 150,000 and the rental income you generate is £12,000 a year. Now, the gross yield would be 12,000 divided by 150,000 times 100. Now, that gives you 8%. So this means you're getting an 8% return based on the value of the property, not just what you've invested as capital. This is the overall value. Now, also, it's important to calculate net yield. The figure I just gave you was for gross yield. Now, net yield takes into account your running costs, such as your property management fees, maintenance, and other expected fees that you're going to be getting. Net yield gives you a much more accurate picture of your actual profit. So the formula for net yield looks like this: annual rent minus all your costs divided by the property value times 100. Now, typically a gross yield of around 7 to 10% is pretty strong, but this can vary again depending on location and property type. So if you're in an area with like high appreciation potential, then a lower yield might be acceptable because over a period of time, your capital appreciation in that property is going to increase. So next, we're going to break down cash flow. This is the real life impact on your investment, and it's something you definitely have to keep an eye on. We do it monthly, but you do need to keep an eye on it regularly. So cash flow is essential for your business to be able to manage and pay for all of those expenses. So essentially, the money left over after you've paid out all of your expenses, like your mortgage, maintenance, management, insurance, etc., etc. This is the real money that goes into your pocket each month. Now, obviously, you're going to get taxed on it as well. So the reality is, once you work out what that profit is, it might only be £300. And you might think, actually, this area is too low for me. I want more like £500 a month. But again, there is a calculation on how to calculate your cash flow. And this is basically rental income minus all the expenses and tax, if you can calculate that. And that gives you your profit. So, for instance, if your rental income is £1,000 a month and your expenses, and this will be including your mortgage and stuff, total £800 a month, then your cash flow that's coming in every month is £200 a month or £2,400 a year. Now, obviously, we haven't deducted tax off that because that's classed as profit. So then you're going to get taxed on it. Positive cash flow is essential because it gives you kind of a financial breathing room, and it ensures that the property investment itself is self-sustaining. Even if your property is appreciating in value and it's doing really well, negative cash flow can drain your savings rapidly. So it'll only take for things like washing machine to go wrong or for a particular repair bill to come in that you weren't expecting. And all of a sudden, your cash flow is obliterated for that property. So you need to make sure you keep a really good handle on cash flow and that you keep some money in reserve for any of those unforeseen hidden costs that might creep up. When I'm talking to you about costs as well, I want to cover what factoring in costs are. These are like hidden expenses that eat into your profit that people don't always consider. So first of all is your mortgage costs, okay? One of the largest expenses for property investors is the mortgage. So when calculating profit, you need to factor in not just the monthly payment, but also any interest rates or any potential fluctuations in those interest rates. Then you'll have maintenance and repairs. So obviously maintenance is a continual cost that can affect your overall profitability. Whether it's replacing a boiler, fixing a leaky roof, these costs can add up over time. So like I said, you have to budget for ongoing repairs. Property management fees. So if you decide to use a property management company, which typically charge between 10 and 15% of the monthly rental income, that can also affect your bottom line. Now, if you're managing it yourself, you might want to charge for your time at 10 to 15%. But these are all things that you're going to have to calculate as cost. Then you've got insurance and legal costs. So often people forget about landlord insurance, but it protects the landlord from unexpected events like tenant damage, loss of rent, that sort of thing. But there's also legal costs for managing contracts, especially if a tenant dispute arises. And all of this can eat into your profit. And then finally, I spoke about the good old tax man. So taxes play a big role in determining profit. So be aware of property tax, stamp duty, income tax on rental profits, that sort of thing. Keep a track of these, and it will help you understand not actually your tax responsibility, but it'll help you understand your actual net income once you've paid out everything, including your tax. Now, we have a little column in a spreadsheet where it automatically deducts tax, so we know exactly what each one of those properties are earning in pure profit. So these are things you can do. Now, before we go, I wanted to leave you with what I call the bigger picture. So this is like long-term profitability and appreciation. So capital appreciation, you probably will have heard of if you're in this industry. And it's one final piece of the profitability puzzle, which refers to the property increasing in value over time. So while cash flow is essential for immediate returns, money in and out as such, appreciation provides long-term wealth. That's where you can start to see your retirement plan coming into action. The other thing is you need to look for areas where infrastructure projects, population growth, job opportunities, student area like universities, large hospitals, that sort of thing, because these factors often drive up prices and property prices and also rental prices. So from your point of view, it's adding an additional layer of profitability to your investment because you picked a good area that has growth going on within that area. And it also allows you to have a consistent rental income if you pick good areas. If I'm honest, it's a balance between yield, which is immediate, obviously cash return, and appreciation, which is the long-term growth. So some properties might have really low yield, but really high appreciation potential, while others could provide excellent cash flow, but there's little growth in the value of that property over a longer period of time. So these are things that you need to be considering and working out, making sure that your portfolio is still profitable, or that when you go into your portfolio and you start buying property, that you are fully aware of what type of property you're willing to buy, what type of yield you're willing to accept. Does it have capital appreciation? So that wraps up today's episode. I hope you now feel a little bit more confident in calculating ROI and yield and cash flow. Remember, property investing is all about knowing your numbers. So don't skip this part. Don't just brush it under the carpet. Take the time to run through calculations and you will make an informed, profitable decision, or you should do. And also, if you're sat here thinking, I want to learn more, then please feel free to go over to the Female Property Expert website. We have lots of free resources, but we also have programs on there where you can learn, and it's very much hands-on learning. So have a look, take your time and see what you think. If you found this episode helpful, please subscribe, leave a review. The reviews really help bump us up. And don't forget to join me next time. We're going to be talking a little bit more about expanding property portfolios and understanding a little bit more about what that involves. But until next time, I'm Emma Morby, your female property expert. Let's make property investing as simple as possible and let's try and do it together. Until then, happy investing.